TV18.
Yeah. Let's take a step down after mixed global cues of a hawkish Fed and unperturbed money markets. IT and metals lead the slide while oil and gas and realty see some green today.
Poonawalla Film Corp inks a pact to sell its housing finance arm to TPG for 3,900 crore rupees, while JB Chemicals and Pharma buys the India and Nepal rights to cardio drug Razel from Glenmark Pharma for about 304 crore rupees.
And the street sees a flurry of share sales after VRL logistics promoters sell a slice. A clutch of foreign investors offload shares in Sapphire Foods, while the government issues a notice for sale of up to 5% stake in IRCTC.
Thermax perks up after it's allowed an appeal against a hefty tax demand, while a likely buyback lifts Hinduja Global Solutions, and SBI Life springs up after analysts turn bullish on the sector and the stock.
And Infosys co-founder Nandan Nilekani says there is no plan B for a new chairperson other than roping in a non-founder. He adds that seeing this through is his top priority.
Good afternoon. You're watching us here on Halftime Report. I'm Mangla Malu. With me is Sonia Shenoy. Not looking very good for the markets, but not particularly bad either. Yesterday, the hawkishness of the Fed's comments and the outcome of the Fed policy meet took the US markets lower, as a result of which we opened slightly lower. And now the Nifty bank has actually turned for the worse, currently at the low point of trade for that index. It is weekly options expiry, so let's see where we go. All the indices at the low point of trade. Hi, Sonia.
Hi, Mangalam. Absolutely. So the market, I think, is moving as per script, right? Post the US Fed's hawkish commentary, the market is just selling off a little bit. I think this all-time high of 18,850 is something that will be a resistance for a while, 18,880 or so. And it's technology stocks that are under quite a bit of pressure right now, whether it's Tech Mahindra, TCS, Infosys. But most global markets are also under pressure. So let's see how the second half of trade pans out. Later in the evening, there's the ECB meeting as well. There could be a 50 basis points rate hike announcement there. So all eyes will be on that from a global standpoint. But let's talk about individual stocks. Now, Poonawalla FinCorp will sell its housing finance subsidiary, Poonawalla Housing Finance, to TPG for 3,900 crore rupees. Abhishek is here to tell us more about this. Abhishek, over to you.
Well, Sonia, as you mentioned, Poonawalla FinCorp is selling its housing finance arm, that is Poonawalla HFC, to TPG Group for a consideration of rupees 3,900 crores. So the deal is priced at a valuation of price to book value of 3.4 times Q2 FY23 net worth. So the deal amount translates to about 51 per share in terms of accrual to Poonawalla FinCorp. Just to talk about Poonawalla Housing Finance Company, it's an pan-India affordable housing finance company. The AUM is around 5,600 crores. The gross NPA is at 0.84% and the net NPA is at 0.53%. The credit rating is AAA, which is given by CARE. However, just to alert our viewers, it's been built only in last 4 to 5 quarters in terms of the AUM growth seen over here, and the book is largely unseasoned as well as, it's not seen a credit cycle per se. So this looks like an early sale at a huge valuation that was given for Poonawalla Housing FinCorp. Back to you.
All right, take that point, Abhishek. Thanks a lot for that. So we will monitor how things pan out once the cycle turns as well, and whether they are able to tide through that. JB Chemicals and Pharmaceuticals is the other stock which is in focus after it's announced it will be acquiring the Glenmark Pharmaceuticals cardiac franchise Razel for about 314 crore rupees. Sonal joins in with more details on that one. Sonal.
Thanks a lot for that. Well, yes, Glenmark Pharma has decided to divest its cardiac brand, which is Razel in India and Nepal, and it will be sold to JB Chemicals for a consideration of 314 crore rupees. Now, Razel franchisee sales for the first half of FY23 was around 29 crore rupees, so the annual run rate so far has been to the tune of 60 crore rupees. We spoke to JB Chemicals. They did tell us that acquisition will be funded 80% via long-term debt and the rest from internal accruals and the cash generation as well. JB Chemicals, remember, has a net debt of 150 crore rupees in its books, and total market size of this new portfolio is 2,440 crore rupees. Credit Suisse has written on JB Chemicals, where they say portfolio would have 60% EBITDA margins, which was confirmed by the company. They said margins are between 55 to 60% on this new portfolio acquisition, and this acquisition is valued at 9 times FY24 EBITDA of Razel portfolio. That's the specific acquisition amount. Acquisition is EPS neutral or marginally EPS accretive for JB Chemicals, And now after this acquisition, India constitutes 2/3 of JB Chemicals' portfolio. So that's the update coming in as far as JB Chemicals and Glenmark Pharma is concerned.
Okay, thanks a lot for that. In fact, it was a very good chat that we had with Nikhil Chopra, the Chief Executive Officer and whole-time Director at JB Chemicals. They spoke about how they're looking to improve their presence in the chronic therapy and cardiology business. They currently have just 2% of the market, which is a 2,500 crore market, and they hope to, of course, gain market share over there. Listen in to what he had to say.
This market is growing at low single digit rosuvastatin and combinations. And for us, with 2.5 to 3% market share in 2,500 crore market, we are looking at in next 3 to 4 years. Why don't we double our revenue? That is what is the opportunity for us. So we have taken long-term debt. I think 70-80% is being funded with the help of debt, and rest will be the cash debt will be generating will help us in terms of how we can fund this. We are looking at, if the initial transition phase, we are looking at to grow at a low double digit. And probably then we want to see the trajectory going from 14 to 15%. So 26, 27, we should be close to 100 crores. That should help us. EBITDA margins are upward north, 55-60%.
All right, that's about JB Chemicals. But the other interesting conversation that we had today was with Tega Industries. So let's talk about a special segment, Insight Edge, where we give you an edge over the insight that the management spoke to us here on CNBC TV18. And Vahishta is focusing on Tega Industries itself. Vahishta.
Hi, Mangalam. Thanks for that. Let me brief a little bit to our viewers about the basics of the company. It's a 4,000 crore market cap company with 86% revenue contribution coming in from exports. The company caters to the global mineral mining and bulk solids handling industry. Like you said, the management did join us today morning, and that they've said that they're completely insulated from all capex cycles or global slowdowns. So that's a positive. Next, the Dyna Prime business, which is the key growth driver to their business, is expected to contribute 27-28% of overall revenues from 24%, which is at present. Q2 and Q3, as we know, has seen a correction in the raw material prices, and the logistics and freight costs have also come down, and hence they expect their FY23 margins to be boosted. FY23 gross margins are expected in the range of 59 to 60%, while EBITDA margins are expected to come in at 21-23% from 19% in FY22. So there's an improvement over there as well. Now, being an export-oriented business, the collections generally happen after the products are delivered to the customers. So working capital days are expected to improve to 130-135 days, including the shipping time, from the current, which is 143 days. So that's also another positive. The current market share of the company is at 5% in the global mill liner market, which will improve to 6 to 6.5% by FY24. And the global mill liner market has an opportunity size of $1 billion. Also, the mill liner product business contribution is at 75% now, which is expected to go to 80% in the near future. But the company is comfortable to maintain the ratio at 70%. And post the capex completion, the company targets a revenue of 1,900 crores by FY26. The stock has rallied quite a bit in the past. In fact, in the past 1 month, it's up already 8%, but in the past 1 year, it's been nearly flat. Back to you.
Okay, thanks a lot for that. In fact, we had a chance to speak to the management. Let's listen in to what they had to say.
We've always maintained that our gross margins are going to be around 59 to 60%, by the end of the year. In the first quarter, we did see some pressure because of the logistic costs still continuing to remain up. But over the subsequent, I think, Q2, we've seen those margins improve because of reduction in costs that have come through. And in the subsequent 2 quarters also, we see that continue to pass through. So yeah, I mean, if the trend continues the way it is as we see today, we do see margin expansion happening for the rest of the year. We maintain the guidance of about 21 to 22% for the rest of the year, to end the year around that level. We'll see our Dyna Prime contributing close to about 27 to 28% over in terms of our overall revenue. We see that pretty much a healthy uptake in Dyna Prime. It's seeing a lot of traction globally. So in terms of market share, I mean, when we last, we just completed our anniversary of our IPO yesterday. So we were at about 5% at that time, and I think we will end up by FY24 between 6 to 6.5% in terms of market share. As you know, it's almost $1 billion market. So we'll be adding almost about 100 million in Dynaprime sales by FY24 to really look at the market share.
All right, let's keep it stock specific then. The other stock which is buzzing around in today's trading session is SBI Life on the back of a bullish brokerage note coming in. Surabhi joins in with the details of that one. Surabhi, 1% higher on that stock.
Hi, thanks for that. So SBI Life is gaining traction in today's trading session. CLSA in its recent report has said that they're bullish on the life insurance space. They've also said that the risk reward is getting favorable owing to the fundamentals turning, and they expect the sector to outperform in the calendar year 2023. They say that the valuations are quite undemanding, and amongst the sector, SBI Life is their preferred pick with a target price of 1650, which they have raised from their earlier target of 1600. Additionally, Motilal Oswal has also a buy rating on SBI Life with a target price of 1600. According to them, the new business premium has seen a strong growth of 26% this financial year itself. Their premium mix has also been improving, where the share of protection and annuity has been increasing. They estimate the value of new business, that is the VNB, will grow at a 38% CAGR in the next 2 years, and expect VNB contribution to operating return on embedded value to improve to 15% in FY24 from 9% in FY20. SBI Life remains the top pick in the insurance sector.
Okay, and that's having a big move this afternoon, SBI Life, and even HDFC Life actually is having a good run. Let's do one thing. Let's talk about IRCTC and the government's plan to do the OFS over there. Mangalam, the stock is under a bit of pressure.
Yes, it is, and there are a couple of reasons for that. One, there is increased supply coming in from the government, so that's negative. And secondly, the price at which the government has put the floor price for the offer for sale is at a 7.5% discount to yesterday's close price. The yesterday's close price on IRCTC was close to around 730 odd rupees, and of which the floor price is now 680. So the stock is adjusting to that. So what is the government offering? The base offer is 2.5% of its equity, and the floor price, which is at a discount, will also be for another 2.5% of their equity, were there to be an oversubscription of the base offer of 2.5%. So with 2.5% plus oversubscription, the government will totally offer about 5% of its stake. As of the last reporting, the government's stake in the company was a little over 67%, 67.5%. So it, of course, will go down to about 62.5% post the OFS. A lot of people were anticipating this to happen, and that is another reason why the stock is under a bit of pressure. So the fact that there is supply, the fact that it is at a discount to its issue price, rather its discount to its previous closing price, and the third fact is that now it is a bit of sell-on news, is taking the stock lower by about 5.5%.
Okay, another stock in focus this afternoon is LTIMindtree. Now, post the merger, there are a lot of brokerages that have written on the stock, and I wanted to identify one such brokerage. CLSA has written, they've in fact initiated an outperform on LTIMindtree, and they have a target price of 49.20 on the stock, which is a big upside to the current market price. They say post the merger with Mindtree, the company will now be the fastest growing amongst the Indian listed IT companies. It will have a market cap in the $10 to $50 billion range. Also, there is superior growth for the company. The balance sheet is very healthy, and the institutional ownership is low compared to its peers. So that's a good thing. It's a very attractive structural play, according to CLSA. The only niggling worry is valuations, which look a bit stretched. Valuations are elevated at 24 times FY24 EPS, and perhaps that could be the reason why the upside could be restricted in the near term. However, very, very good growth outlook coming in from CLSA.
All right, that's about CLSA. Meanwhile, just keep an eye out on the flashes coming to you on the bottom of your screen, and this comes in from Bloomberg, where the Rice Exporter Association of India will call on the government to actually remove rice export curbs. Remember, the Rice Exporters Association will be seeking scrapping of the 20% cap that the government had imposed on white rice exports. India usually accounts for nearly 40% of the world rice exports. So if exports are curbed, it's not particularly good news for rice exporters. So now, as a result of which, they are planning a call on the government. Whether that happens and what the outcome of that is something that we will await. But if that does happen, that will be a bit of a positive. But until that happens, all these stocks are slightly lower. So you have KRB, you have LT Foods, both of them mildly lower in trade, not reacting to the fact that there could be a possibility of a call. Maybe they will react if there is a call and a decision taken thereafter. With that, we'll step into a short break, but on the other side, you stay tuned, because we'll bring you an exclusive, a special conversation with Neelkanth Mishra of Credit Suisse on our series Outlook 2023.
Welcome to our series Outlook 2023, and I start today with someone whom even the government listens to. I have with me Neelkant Mishra, member of the PMEAC. Of course, today he is here as the head of equity strategy India and Asia Pacific at Credit Suisse. Neelkant, thank you very much indeed for joining us. Well, let me start with an economy question and then go to markets and earnings. Most people have marked down the economic growth for next year around 6%, the RBI's number, mainly fearing global slowdown. What's your estimate?
No, I think that's too conservative. I think that the economy currently is doing far better than what official data reports. I think the investors, or I would say even forecasters, are struggling with what tends to happen when you see a big break in trend. Generally, trend is a friend for forecasters. And if things are going along very steadily in one direction, it is very easy to suggest if the economy's trend growth is 6.5, whether you are at 6.7 or 6.3. If suddenly you see a break like what happened during COVID and then a sharp rebound, it is not just a challenge for forecasters. Sometimes even the NSO, the official government body, struggles to put the numbers in place. So we think that the economy is a lot closer to the pre-pandemic path than what even official data is suggesting. And the slope of the curve, which is the growth that occurs going forward, is also going to be better than what consensus is at. So we are going to slow from here. We are slowing down, but we are not slowing from, say, 7.5% to 6% or 5.8%. Which is where consensus is.
Yes.
We think we are slowing from, say, 9.5% to more like 7%.
Okay.
The time at which this data gets revised up will be too late.
Yeah.
But from the perspective of those of us in the markets, I think it's already visible in revenue growth for many of the companies.
Okay. Well, the later revisions have also been lower in previous years. But, time permitting, I'll come back to the economy. Our viewers will want to know more about earnings. The global facing sectors, like IT and all, have already seen earnings cuts. What's your estimate? FY23 itself and FY24, are we going to see big earnings cuts?
Not at all. So on earnings, I'm actually quite, as you can expect from my view on the economy as well, that we are quite positive on the 12-month forward EPS. So whatever is the 12-month forward EPS now, in December 23, it is likely to be 12 to 15% higher. Current forecast is for 15% higher number. We expect there will be some cuts. That is absolutely normal in any market, including ours. And there are, as you rightly said, many global facing sectors, IT, metals, refiners, and I think some of those can come under pressure. But on the whole, I think double-digit earnings growth is reasonably likely.
Okay, when you say double digit, you mean mid double digit, like 14, 15% for FY24?
12 to 15% is...
Fair enough. Yeah, fair enough. I mean, that's a reasonable range to work with. Now, where does this leave markets in terms of share prices? We are already seen as guilty of too high a premium compared to our own past and compared to our past vis-a-vis other Asian economies. So will that be a problem stalling indices movement in 2023?
That has been a problem for the last 15 months as well.
Yes.
Right? So in September 21, we started flagging that, look, we are very positive on the Indian economy. We think that medium-term growth looks the best I've ever seen as a top-down forecaster. And yet, my view was that the market was going to time correct. And that's exactly what it has done the last 15 months. I have a view that I think that time correction may last another 6-9 months. Now, of the three parts of the market, right, or the three parts that decide the market level, there is the 12-month forward EPS, there is the global price to earnings, and there is the India's premium. Now, so the Indian PE I've divided into two parts, global PE and India's PE premium. Now, the global PE is, it consists of the risk-free rate and the equity risk premium. So put simply, US Treasury bond yield, which is supposed to be the dollar yielding risk-free rate in the world, and what additional returns investors would want, because they're investing in an asset class which is naturally risky and volatile, which is equities. Now, both the 10-year bond yield, so the 2011 to 19 average for the US 10-year yield was in the 2.1, 2.2% range. Even though yields may fall, they are unlikely to go below 3% in the next 12 months. Secondly, the equity risk premium, given that global growth is going to be a challenge, there are geopolitical risks, ERP is also likely to rise from here. And remember, there is always a discovered number. It is never a model number, in the sense that you will see some shock on growth, you will see some shock on geopolitics, equity is correct, and that then you say, now the ERP has gone up.
Yeah.
So both are risks. Therefore, global PE has corrected, but I think we are unlikely to see it rebounding to levels that we were at 2011 to 19. PE premium has been a very large driver of India's performance in the last 12 months, the expansion in India.
Yes.
It is now at levels where, it has been higher than this only 3-4% of the time in history. Now, there are people who want to say that, look, why can't it go to all-time highs, create new highs? Now, see, in markets, we all deal with probability.
Yeah.
So nothing is impossible. We, as sensible investors, have to work around the probabilities of something happening when it has not happened for 25 years. And so my sense is that the PE premium is unlikely to expand. It may actually moderate from here.
Okay.
And if global PE is also moderate, then the 12 to 14, 15% earnings growth that I expect in the 12-month forward EPS may be the ceiling for market performance at a headline.
Okay. But what about the argument that now we have very good domestic support for earnings? I mean, even if in comparison to other countries, we are higher in terms of premium, we look too expensive. For the domestic investor who doesn't look outside and who is now migrating from bank accounts to investment products in a huge way, can that continue to keep us expensive but still rising?
Which is why I expect that the trend will be time correction instead of a very sharp decline.
Okay.
But let's put those numbers in context, right? So insurance flows are very strong. They tend to have a bit of mean reversion in them. So you would have seen insurance companies, the largest ones, were selling in September quarter last year and were buying in September quarter this year, right? So when the stock markets fall a lot, they go and buy. When they, because they have a certain weight, and if the weights change, they tend to go in the reverse direction. So they have a mean reverting trend. EPFO is, if the 20% of incremental flow decision comes through, there will be $7-8 billion a year that can come through from that. The SIPs are adding another $18-20 billion. But remember that about 50%, 52%, so more than half of the mutual fund AUM in equities is from non-SIP retail, right? So there are, and they are very sensitive. I mean, they're very sensitive to the advantages of other asset classes. So what we have started to see, as India's ERP on Indian GSEC yields has actually gone to negative territory, meaning that Indian sovereign bonds are now cheaper than Indian equities.
Okay.
Not surprising that they are starting to buy more bonds. The real estate market. So if this so this can be the counterbalancing force. So I don't expect, and frankly, whether this happens or not, frankly, expecting that the crowds will go mad is not a very sensible way to invest.
Okay. No, I take your point that it's extremely tempting if the government of India is offering 7.5% and AAA companies like a Bajaj Finance may offer 8 or 8.5. It would be very tempting and difficult for equity markets to weather that competition, and real estate is also getting attractive. But let me come to the moot question. What would you therefore bet on? Will financials continue to be the darlings because now they are reasonably expensive?
Absolutely. So what we start off this choice of sectors with is, what would the price to earnings be 1 year from now, right? So on current forecasts, and how many standard deviations above or below its 10-year average, which we call the Z score. And financials are an outlier in terms of it being very cheap when you look at what the PE multiple is going to be 12 months out. On top of that, we overlay what is the risk of earnings cuts. And again, on financials, there is very little reason at this stage to be expecting earnings cuts. So I know they are a consensus buy. They have been a consensus buy for a very long time. But occasionally, you have to resist the temptation of saying something new just for the sake of saying something new, and persist with what the numbers are telling you. And I also think that the domestic economy, if there is no accident or a very tight dollar funding situation in global markets, if that happens, then there are risks to growth in India as well. But if that accident does not happen, then the probability of India growing very well is very strong. And banks and construction and cement and some of these are the best ways to play it.
Okay. Just a finer question, not final. How do you look at the capex cycle? Has it arrived? We obviously see the central government capex doing very well. The monthly numbers are intact. We understand the state capex is also picking up. We have yet to see the data. So do you think the tomorrow's sector, which will compete with financials, could be, the L&Ts, the cement, any of the construction related, capex related stocks?
Absolutely. So we think that that is happening. In fact, one of the data points we have been watching very carefully is government cash balances with RBI. That in September was 5.6 lakh crores or so. It is now fallen to below 2 lakh crores.
Yes.
So it's a sign. And this has happened despite strong tax collection. This has happened despite more or less in line borrowing versus target.
Yes.
Which means that arithmetically, that means that, it has been spent. And even if it was for settling long pending dues to other construction companies, that means that activity levels will pick up. And so I think that segment is going to do well. I think several state governments are very, very actively looking at infrastructure spending, in addition to, of course, the fact that you may have seen a very welcome change that even railways capex,
yes,
they were for supplementary grants, and which is very heartening, right? So the only limit on railways capex was it was not fiscal, and the government could have given them more money. It was their ability to spend, and the fact that they are starting to spend. So there are many reasons why I think construction and investment in general, but a very important factor, let's not forget that a very large part of GFCF is dwelling construction. A very large part of the gross fixed capital formation is dwelling construction. And the dwelling construction has been subdued for nearly a decade. We started talking about in November last year that, look, signs are very, very strong that we are in for a multi-year surge in dwelling construction. And that's playing out. So we are seeing some price signals. I'm just hoping that prices don't go up, real estate prices go up too much, because you would want volume growth, not price growth. But this better price is also a good signal for real estate developers to accelerate construction.
Fair point. I'm asking you a final question because I've been warned out of time. But this is the devil's advocate question, the skeptic in me. The IIP number, I know it has its problems, but it has its delta. It directionally has been right in the past. Minus 4% in September, even in October. Even if the intensity is not correct, the direction is troubling. And a whole host of FMCG companies tell us that volume growth is, low single digits. There seems to be a demand issue. Do you worry that you're too optimistic on growth?
No. I'm an analyst. I'm very worried about my forecast at all times. So I'm very careful on all data points that we see. It's important to recalibrate at all times. But frankly, the data points that you suggest are not reasons for concern for me at all. In fact, what you see on IIP, and look at the NSO's own estimate of industrial output, over the last 10 years, there's a 30% gap. The first read of IIP, I mean, it's marginally better than garbage. I know it's with a very strong words, But I think we waste everyone's time by analyzing that data, so I will not spend more time. If you want, I can tell you why IIP is underrepresented. We've written a whole note on it. So let's not waste your viewers' time with this IIP is weak. The second one on low income consumption, that's a very real concern. There has been a weak demand in the bottom half of the income pyramid. But I must say that in the last couple of weeks, we are starting to see signs that it is reviving. So if governments start doing construction capex, if hotels start hiring, if airline traffic schedules are back to pre-COVID levels, if railway passenger traffic is starting to get close to pre-COVID levels, a lot of the 8, 10, 12, 15,000 rupee per month jobs get created.
Okay.
And once that starts happening, so this is, and in the US, and in our Outlook note, we flagged this charts from the US. We don't have that granularity data in India. That, during lockdowns, there was $1.5 trillion in the US of foregone consumption in the top quartile, and it was $1.5 trillion of foregone income in the bottom half. The same happened in India. So the moment you open up, this starts flowing, and this is where you are starting to see trends change even in India. So I know there has been a problem till 3-4 months back, but I think in the next 12 months, I would be much more positive, which is why we prefer staples over discretionary, that incremental data points are going to be much stronger for the low income segment than for the upper income.
Okay. On that optimistic note, Neelkanth Mishra, pleasure speaking with you. Thank you very much for joining us. Have a great 2023.
Thank you, Dada. Thank you, ma'am.
Well, we're going to a break and we'll be back with covering markets.
Welcome back. You're watching us here on Halftime Report, and this is the time where we also talk about the way the futures and options space has been shaping up in the first half of trade. It has been a weak session. The Nifty is now firmly below that 18,550 mark as well. So the call writers are extremely active at the 18,600 level. 18,600 is extremely important because, we've seen a fair amount of call writing, and the street believes that maybe for a premium of over 100 rupees, one is expecting some sort of resistance at yesterday's high of 18,696. 18,550 put writers, they were active for the first half of trade, and now those options have been unwound as the Nifty has fallen below that 18,550 mark as well. Earlier, they were seeking a range of 18,520 to 18,630. Let's see where that range goes now, because now we're at the lower end of the range. And where we are at on the Nifty right now, it's extremely important to watch out for the 20-day moving average, because the 20-day moving average too is at 18,527. So were the market to bounce back, this is the point. If not, then maybe we're seeking slightly lower levels.
Okay, well, let's get into this discussion with Ashish Kyal of Wave Strategy Advisors. He joins us on the show now. Ashish, hi, good afternoon. What's your sense of which way things are headed? You think the all-time high is a distant dream now, or can we get back there soon? Is this still a buy on dips market?
Afternoon to you and all the viewers. See, if we can look at the, there are two things here. One is Nifty and other is Bank Nifty. The reason I'm saying that is we can clearly see Bank Nifty strong outperformance over past few days and touching lifetime high levels, whereas Nifty struggled to even go towards that, crossing that 18,730 mark, and we can clearly see a reversal happening again today. So it looks, it's not very often that you see two such major indices moving in divergent fashion. Having said that, Nifty looks to be weak as of now. It has a huge open interest build up on the call side at 18,600 levels. So crossing that today looks difficult to do that. And I think from the lifetime highs, it might be not that difficult, but we need to definitely cross back above that 18,630, 18,650 if we want to really head back towards that 18,900 level. So that's the first resistance zone we are seeing. I think the overall range of Nifty is going to be 18,420 on the downside and 18,650 on the upside. That's the broad range. And for today, use pullback to sell as long as 18,650 is intact. We can also see an evening star pattern so far being formed. Let's see the closing today, and if the closing happens to be below 18,630, it will be a lower high and a lower low formation on the daily chart. So 18,420 is the target, 18,650 is the resistance, and sell on rise is the tone.
What about individual stocks? What are you looking at? Today there are plenty of pockets despite the markets moving downwards, and now it's actually down 130 odd points. there are plenty of pockets that are looking good, right? Whether it's some of the fertilizer names, you have the banking stocks. So from a trader's perspective, any stocks that you like now?
Yes, the first stock on the is on the buy side is Piramal Enterprise. We can clearly see PEL is showing after a long time a good traction on the upside. It is forming a classic inverted head and shoulder pattern, which suggests a bottoming pattern, and it's just about to break the neckline. So I think Piramal Enterprise can possibly head towards the level of 978, which is the pattern target, as long as the level of 882 is intact. So use 882 as a stop loss. The next stock on the buy side is Raymond. We can see this space is buzzing. Raymond has shown a very promising returns, has given already strong returns to the investors. And over short term, I think we saw some dip, and this is the opportunity to buy the stock again. Bounce back from the 20 days average now, and looking like headed towards 1580 again on the upside. So one can create long positions in Raymond for the target of 1580 over short term, and stop loss can be maintained at 1426.
All right, we take that point. Ashish, thanks a lot for joining in and giving us all those details on individual stocks, as well as the index itself, where he believes that sell on rise is the way to go right now. As we speak, we are trudging around at the lows of today's trading session. What we do is take a short break. On the other side, we talk about an important milestone for an important company, Infosys. The founders meet to mark the 40th anniversary of its founding. What a story it's been. And we get you excerpts from our conversation with the founders of Infosys on the other side. Stay tuned.
Welcome back to Halftime Report on CNBC-TV18. Well, Infosys was started as a startup. Can you believe that? And the company celebrates 40 years of existence. Shireen Bhan asked the non-executive chairman and the founder, Nandan Nilekani, as to what gives him confidence and inspiration in the current startup ecosystem, and also the pitfalls that could come in the way of young founders finding their feet in business. Listen into what he had to say.
What impresses me with many of these young founders is their ambition, their understanding of business, the strategic thinking. Some of them are exceptional in that. What worries me is, do they want to build an institution? I think really the hard part is to build an institution. You know, it's a marathon race. You run for it for 30, 40 years now. And today we are as optimistic and as working as hard as 40 years back. So I think, do these guys have the stamina to play the long game? I think that's what worries me, because too much money is a curse. Especially, when you start a company, some guy says, I will give 1 billion, 2 billion, spend more. I mean, I don't understand how that works. Because then once you lose respect for capital, once you lose respect for frugality, once you lose respect for managing your expenses, then the game's over. So I think that's what worries me about it. But having said that, many of them who are very sharp, who are keen to build long-term firms, and I see them all the time. So I think overall I'm still very bullish on the startup world.
Okay, well, you can catch snippets of this conversation all through the day and the full interaction later this evening at 7 p.m. Let's slip into a quick break. On the other side, Manisha Gupta joins in. She has with her former Agricultural Secretary Siraj Hussain. Do stay tuned in.
Reimagineering brighter futures with smarter steels. ArcelorMittal, Nippon Steel India. Smarter steels, brighter futures.
Presenting the next challenge between two animals.
Who seems faster amongst the two? Then why place all your bets on the elephant? Similarly, in investments, horses are like smaller companies. Even with ups and downs in the journey, they can run faster than the elephant like big companies and show higher potential. Along with investing in the horse, what if you also get tax savings? That's right. Introducing Samco ELSS Tax Saver Fund that aims to create wealth for you by investing in high-quality small and mid-sized Indian companies and also helps you save tax with ELSS. Invest today. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
उत्तरवीर कमाल दिखा अपना कभी टेबल बन जाता है तो कभी अलमारी वीर MDF आम प्लाईवुड से ज्यादा मजबूत ज्यादा किफायती दिखे चकाचक दिखे टकाटक
Let our choices today be driven by hope and not by fear. Let's work towards a society where people are not prisoners of their circumstances but active participants in shaping their future.
This is my time to shine, taking back all that's mine. This is my time. This is my time.
Well, meandering around the lows of today's trading session, 0.75% for the Nifty as well as the Sensex. The Nifty Bank is the one which has had the most impact on the frontline indices in just the last half an hour or so. The Nifty Bank is actually the one which is now at the low point of trade, below that 44,000 mark as well, the one that it hit in yesterday's trading session. And also the mid-cap index, which while it is outperforming, it has taken a knock for the worse as well, 1/3% lower on the index level. But the story of the day really is the advanced decline. Where we started the trade, we had around 1,800 stocks advancing, while the number of decliners were much lower. And now as we speak, the red line has actually gone ahead and intersected and gone above the green line. So we have around 1,500 stocks declining for just about 1,300 stocks advancing right now. At the bottom of your screen from Bloomberg, we have Europe car sales rising 17% year-on-year in November as supply constraints have eased. That was perhaps expected. But on news such as these, we do have stocks like Motherson, etc., do perking up. So let's pull up the intraday chart of Motherson and see whether there is any impact on that one or not. European car sales rising 17% year-on-year in November as supply constraints do ease. What we'll do is actually take a short break. On the other side, we talk about all things commodities. Manisha Gupta joins in with former Agricultural Secretary Siraj Hussain.
देश का हर अरमान पूरा करे एक नाम श्री राम बोना उगाना कारोबार चलाना हंसाना मनाना वादे निभाना कोची मोहाली राजौरी वाराणसी मुंबई पन्ना शिमला बड़ौदा श्री राम के साथ आगे बढ़ना श्री राम फाइनेंस लिमिटेड आपकी प्रगति का साथी।
आग को फैलने से रोकना मुश्किल है पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाइड क्लब प्राइम आग से बचाए।
This tax season, invest in Samco ELSS Tax Saver Fund that aims to create wealth for you by investing in high-quality small and mid-sized Indian companies. And the best part, also saves tax with ELSS. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Will snow days be a thing of the past? Or are we smarter than that?
असली विलन तो तू है अपनी फैमिली का हीरो बनो यार। 1 करोड़ का हेल्थ इंश्योरेंस सिर्फ 390 रुपए महीने से शुरू फ्रॉम पॉलिसी बाजार।
Volkswagen Tygoon, India's safest SUVW. Volkswagen.
Welcome back. Joining us on the show now is Siraj Hussain. He's Senior Visiting Fellow ICRAD and former Agri Secchi as well. Mr. Hussain, good to have you. And let's talk about the wheat first, where we do understand, as per the latest data that has come in from the government, that the wheat stocks last year, same time, were 37 million tons. This time is 19 million tons. We have known all the way that the procurement has been lower and the stocks have been lower. But the latest number for December has come in, and that clearly tells us that nothing really changes. How concerning is it, looking at the fact that we've seen 28% gains in wheat prices in this year, and the new crop only comes in by March, and the government doesn't hold enough stocks?
My expectation is that the government will go by the advice of Dr. Ramesh Chand, who is a member of Niti Aayog and a very reputed economist. He has said that there is no need to continue with PMGKY beyond December, and the government should release some 4 million tons of wheat and rice under open market sale scheme so that the market prices can cool down.
You're expecting this release to the tune of 2 to 3 million tons. At least that is what the markets are talking about. And if that is the kind of release we see, how much of a correction would that really bring into the markets?
I can say that the increase in availability for flour mills and other bulk consumers of wheat can bring down the prices from about 28, 29 rupees to about 26 rupees or so. So it will have an impact of 2 to 3 rupees per kilogram, which is not a bad deal.
Okay. Mr. Hussain, also when we look at this crop itself, the sowing is up by nearly 25%, but we did see high sowing last year as well. It was weather which played a spoil spot. And this time around as well, there are conversations about how it isn't cold enough in growing areas. Are we headed the same direction this year too?
I hope not, but I can see sitting in NCR that the temperature should have been lower than this. And Mr. Ajay Jakhar tweeted the other day from Punjab that his Malta crop is blooming. Normally it should be blooming in February, but it is already blooming. So we hope that the temperatures will fall down to about 15 degrees or so that the wheat crop can mature quite well as compared to last year. Otherwise, if we have, God forbid, a situation similar to last year's, then I'm afraid we may have to import wheat.
Oh, okay. That's been a concern for some time now. I also want to talk to you about rice, because the international rice prices have gained up by nearly 18 to 19% in this year until now. India clearly has had a lot of measures, restrictions when we look at various agriculture crops. There is already a committee, or rather, the rice industry basically asking the government to open up rice exports. You see that going through though?
No, I think the government has taken a correct decision by estimating the lower size of the rice production this year in Kharif crop. And therefore, I do not think the government is going to ease restrictions on export of non-basmati rice. In fact, the export of boiled rice is not restricted. Similarly, the export of organic rice is not restricted. And lastly, we must remember that the Indian exporters, for a variety of reasons, quote lower prices for similar quality of rice as compared to Thailand and Pakistan. So this should not be happening. And, some experts have argued that this is perhaps also contributed by very large releases of rice under PDS through PMGKY, some of which may be leaking for export. We have no proof of that because there is no detailed evaluation study which has been conducted. But that could be one of the reasons why our rice exports fetch a lower price.
Well, of course, as you said, there's no proof of that, but there's something that we can absolutely keep an eye on. In the meanwhile, there's expectations of the government, especially acting upon wheat in the open markets, and that is something that we'll watch out for. Mr. Hussain, as always, thank you so much for joining us. And with that, it's a wrap on Halftime Report, but Business Lunch will take all the action ahead.